Okay, good morning, everyone. Welcome to day 18 of the program. This is Saturday, the 20th of March, 2021. Today we'll continue from where we stopped, where we'll be looking at group adjustments, and we'll be wrapping up the section of group adjustment today in preparation for moving to the next level of our discussion with respect to our journey so far. Okay, last time we met, we discussed group adjustment with respect to unrealized profits and also with respect to adjustment for depreciation. Now we look at unrealized profits relating to sale of goods and unrealized profits with respect to sale of assets, whether depreciable or not. And likewise, we move further to look at adjustments with respect to depreciation. With respect to depreciation as it arises from the asset that was disposed within the group. Okay, and today we'll be moving forward to looking at adjustment regarding elimination of intercompany balances. Intercompany balances are balances between the parent and subsidiary or across the group, where one member of the group has a receivable from another member of the group, while the other member of the group have a payable to another member of the group. And this is what we need to discuss today. Now, first, why do we need to eliminate intercompany balance? We need to eliminate intercompany balance because not eliminating it will only be tantamount to mere addition of balances in order to produce the consolidated balance. The consolidated balance of a group should be a balance that is attributable to its relationship with external parties or third parties, not necessarily with other members of the group. The essence is this: the mere addition of all balances, including intercompany, will only be tantamount to having a summation of balances with respect to assets and liabilities without reflecting the economic and the financial position of the group as a single entity. Therefore, in order to produce the true position of the group as a single entity, it is paramount for us to, at all points in time, eliminate balances across the group. For example, the parent might have sold goods to the subsidiary, and as at the end of the year, he has a standing balance from the subsidiary. In the books of the parent is going to record as part of his trade receivable amount owed to it by a subsidiary. And likewise, in the subsidiary's book, the subsidiary will have recognized a payable along with the trade payable, which is due to the parent. Now, upon consolidation, it will be erroneous for us to add such intercompany receivable along with other receivable from third party to constitute group receivable, because that component of intercompany relates to a member of the group, which means there's no way you could owe yourself within a group. Likewise, the payable leg also, it will be wrong for us to consolidate with other third-party payables, or because such a payable will have to be eliminated in order to produce the actual payable outside the group. And that's what we are trying to discuss with respect to elimination of intercompany balance. Now, when we eliminate intercompany balance, that is only when we can truly know what the true position of the group is with respect to its receivables and with respect to its payables. Otherwise, it will just be mere arithmetic process of addition rather than consolidation. Now, to do that, we base that on a premise that the balances in the books of both parties are the same. That is, a parent claimed a receivable of 20 million from the subsidiary. Likewise, the subsidiary claimed a payable of 20 million to the parent. Upon that, that is when we can cancel out. But as we move through this journey, we'll discover that practically not all instances can they have the balance to be in agreement. And later on, we'll look at what are the reasons or what are the justification for that. And apart from understanding the reasons, the next order for us is to ask ourselves, What then do we need to do when such balances fail to agree? And that is the second thing we are going to consider today. Thereafter, we also extend such to elimination with respect to intercompany loans. Okay, and we'll wrap it up with issue that borders on dividend that has been declared appropriately and conclusively by the subsidiary, which is payable to the parents. When such constitute a balance, how do we treat such a balance? These are the adjustments that we are going to consider today in wrapping up on all of our discussions with respect to group adjustments. Now, before we go, I will entertain questions either from what we have done with respect to group adjustments in the immediate past and what we just discussed preliminarily at this level. The floor is open. Thank you very much. I can't hear anyone. The floor is open. Miriam.
Yeah.
Any question?
Not yet.
Okay. Enaru, any question?
No.
Bashir, any question?
I don't actually have question. I think the question I raised earlier before today was in respect of dividend adjustments, which you've mentioned that we are still going to cover it today.
Okay, thank you. Sister Tumilayo.
Well, no, I don't have questions. I'm sure my questions will come in later.
Okay. Sama, are you there? Okay. Madam Kalawole, any question yet? We can't hear you.
No question yet, sir.
Okay, well, thank you very much. Okay, Naro, are you trying to say something?
No, not at all.
Okay. Let's use a simple illustration to depict our understanding. Now let's look at this scenario. Okay, Marian, I want you to read this scenario to us, and we'll move on from there. Marian?
Intra-group current accounts, is it this one that is on the screen?
Okay, just wait. I think the screen is on pause. I'm going to share it with you now. The screen is on pause. I believe you can see it now.
No, hasn't changed. No.
It should now.
Okay. Illustration 7. Pali PLC acquired 160 million of the shares of Suzy PLC since the incorporation of that company. The statement of financial position of the dual companies as at 31st December 2015 were as follows. Statement of financial position of Pali and Suzy. We are to approach, sorry, please, can you scroll down?
No, that's just the end. I want you to read the items that constitute the balance sheet. I don't want you to skip anything, because without reading it, you miss up the main issue that we are to discuss.
Statement of financial position as at 31st December 2015 for Pali PLC and Suzy PLC. They're all in millions. Non-current assets, property, plant, and equipment for Pali 110 million, for Suzy 120 million. Investments in Suzy PLC is 100. Current assets, inventories for Pali 30, for Suzy 45. Trade receivables 15 for Pali, 12 for Suzy. Current account of Suzy 10. Bank for Pali 5, Suzy 7. Total assets for Pali is 270, while total assets for Suzy PLC is 184. Equity and liabilities. Equity, ordinary shares 80 naira for Pali PLC and 100 for Suzy PLC. Retained earnings 140 million for Pali PLC and 60 million for Suzy PLC. Current liabilities, trade payables 50 for Pali, 14 for Suzy. Current accounts for Pali. Current accounts Pali 10 for Suzy. Total equity and liabilities 270 for Pali, 184 for Suzy PLC.
Now, if you look at the question, well, the question is silent and you are told to prepare the balance sheet. If you are observant, what will you see that is unique in the question? What is unique in the question? Can you highlight it?
The intercompany balance between Suzy and Pali, current accounts 10.
What is key in the question is what you have mentioned.
Current account.
Now, look at what you have mentioned. There's a current account maintained in the books of Pali with respect to subsidiary Suzy of 10. And likewise, similarly, Suzy also maintained current account in favor of the parents, 10. Now the question then is, if you are not conversant of this, you will go ahead to consolidate by mere adding the balances entirely, which will not have been correct. Yes, your balance sheet will agree, but it's not going to reflect your financial position. And that is one of the reasons why the nomenclature was changed from balance sheet to statement of financial position. Because people mostly believe that anytime your balance sheet agrees, all is well, but that is not necessarily correct. Okay, what it simply means is that the parents may have sold goods to the subsidiary, probably from what resulted from last year, last time of our discussion, and it has a standing balance to collect from subsidiary of 10 million. Likewise, the subsidiary also acknowledged that, yes, I'm owing my parent what? 10 million. The question is, what implication does this bring when we are to consolidate? What we need to do at this point is to eliminate, which means you cancel this against this. And I said this is on the assumption that this 10 and this 10 are the same, which is in this case. Now, how do we do that? To eliminate, intercompany balance. We'll make use of accounting entries with respect to debit credits. Now, this is intercompany receivable. This is intercompany payable. And intercompany receivable has what balance? Debits. Intercompany payable has what balance? Credits. Therefore, to eliminate an account that has a debit balance, what do? You debit the account that has a credit balance to eliminate an amount in it or reduce an amount in it. Thereby, we'll come here to say current payable account. Which is in favor of PALI, and credits. Intercompany receivable account that has a debit balance. Current receivable account. D from Susie. How much? The 10 million naira. Such that upon consolidation, we just merely take it out, which we are going to see. And that's just all. But as simple as it is ABC, if you are not observant to identify what are the balances across the group which requires elimination, you will have produced a group account that is not a true picture of the financial position. Therefore, let us proceed. What is our group structure? We bought 160 million shares out of how many? Now the share capital here is 100. To know the number of shares is the 100 divided by 50 kobo. Would give us what? 200 million amount of shares. If you consider this as a ratio of 200 million shares, what it gives is what? 80%. Therefore, we'll come here to say our structure PALI, Susie, 80%. 20%. Date of acquisition, since incorporation. Remember the implication of since incorporation the other time? And we are consolidating as at the reporting date, 31st of December, 2015. Susie's reserve as at the end of the year can be split into pre-acquisition, which in this case as at incorporation. And we all know that upon incorporation, no company is giving birth to with profit. And post-acquisition. Or loss, which usually is the balancing what? Figure. What is the profit for the year? The profit for the year is 60. Therefore, the balancing figure this plus 60. Therefore, the balancing figure will be plus 60. Now let's determine goodwill, if any. Cost of business combination. Pallet investment in Suzy. NCI's investments. The fair value of the net assets acquired, share capital, and pre-acquisition reserves. Now, what's our share capital? 100. And what's our pre-acquisition reserve? Is 0. Therefore, coming will say 100 and 0. That gives us what? 100. What is my NCI? My NCI is 20%. This 20% here. %20 of 100. That's 20. What is our investment? It's 100. I give 120. All things being equal, we have goodwill of 20. Now, what's our consolidated reserve? And NCI as at the reporting date, 2015. Consolidated reserve, NCI, all figures in millions of naira. Pallet reserve, $140. NCI as at acquisition date is 20. Share of post acquisition profits. What ratio is that? Ratio 80 to 20. 80 to 20. 80 to 20 of what? Of 60. Which is 48 and 12. All things being equal. What do you have? 188 and 32. Okay. Now, let's draw up our balance sheets. Let me see if I can borrow balance sheets from here. Okay. Let me clean it up. Okay. Now let me copy the question beneath. Okay. PPE 110 and 120, no adjustment. That's 230. Investment cancel out, giving out goodwill. We had goodwill of 20. That gives 250. Inventory 30, 45. That's 75. Receivable 15 and 12. That's 27. Let me take this out. Okay. I have current accounts. I have 10, nothing here, means 0, 10 and 0. But if you recall, there's an adjustment here that we said we should eliminate intercompany receivable by how much? By 10 million. Therefore, I'll come here and say minus 10. Credit a receivable account or an asset account is negative. And when we sum everything together, it becomes what? 0. That is how we have eliminated the balance. Bank. Bank. Five and 7. Which is 12. When you add everything together, $75, 27, 12, you have 114. 114 plus 250, you have 264. Pali share capital, 80. Consolidated retained earnings, 188. That is equity attributable to Pali. Equity attributable to NCI. What is NCI? 32. That gives us total equity of 300. What is payable? Payable is 50 and 14. That is 64. And we have current accounts. Here is nil. Here is 10. That is 0 plus 10. Don't forget, we also said something that we should eliminate the intercompany payable by debiting that account with how much? 10. A debit to a credit account is a negative, a reduction in the amount. By how much? 10. And that gives what? Nil. Nil or 0 plus 64 will give me 64. What do you have? 364. Does that make sense? That is how you eliminate intercompany balance. Now, again, the question might not come in this way. Even though in real life, when you are preparing your account, you are the one that is even classifying it or grouping it. You know what is intercompany. But sometimes, for examination purposes, that intercompany balance will be embedded inside trade receivable, and it will be embedded inside trade payable. What we then do is that this 10, you take it off from here and say minus 10. This one, too, you take it off from here minus 10. Therefore, the other balance is what you put here and here. Which means it's possible for intercompany balance to be shown separately in line with IAS 24, whether as a note or in the account. Okay, in this question, the examiner has chosen to show it in the account, which is more easy for you to identify. But in other questions, it will be embedded in trade receivable and trade payable, such that additional information will be provided to more or less tell you directly or indirectly about balances that are across the group. Any question? Any question? I gave it as an assignment. I believe we all got it right. Okay, let's look at the second scenario. The second scenario was attributed to the fact that the balance so-called that we call 1010 was not 1010. I think that's the second assignment I gave you guys. That's the scenario. Was not 1010. What was it? Let me cut it out. This is what we have. I want somebody to read it out. And let's try to identify what the issue lies. And now I want you to read it now.
All right. Maybe you bolding it a bit. Is a little bit very tiny.
Okay, let me enlarge.
Yes. Okay. Okay, it's fine now. Okay, it's fine. It's fine. It's okay. Pali PLC acquired 160 million of the shares of SUSI PLC since the incorporation of that company. The statements of financial position of the dual companies as at 31st December 2015 were as follows. Statement of financial position as at 31 December 2015. Pali PLC and SUSI PLC all in a million. Non-current accounts, property, plant and equipment, Pali 110, SUSI 120. Investment in SUSI 100, Pali. Current account, inventories, Pali 30, SUSI 45. Account receivables, Pali 15, SUSI 12. Current account, SUSI, Pali 10, SUSI nil. Bank, Pali 5, SUSI 7. Equities and liabilities. Equity ordinary shares at 50 kobo per share, 80 Pali, 100 SUSI. Retained earnings, Pali 140, SUSI 60. Trade payables, Pali 50, SUSI 16. Current account, Pali, Pali nil, SUSI 8. So total equity and liability 270 for Pali, 180 for SUSI. Same thing with total assets.
Okay, where does the issue lie here? Who can tell me?
Okay, I think the issue is in the current account balances are not the same. The current account balances are not the same.
The current account receivable from SUSI shows 10, while the current account payable to Pali shows what? 8. Therefore, there's a problem. We expect that this 10 and this 10 and this 8 should be the same. But now, one is showing and one is showing 8. Therefore, there's a question mark. Who can tell me what would have caused this difference?
Let me just really say something there. There are several, from practice, we have seen a lot of these, but I think one is when transactions are on transit, as at the reporting date. So this can lead to this. Transaction in transit can be goods in transit. It can be maybe payment that is in transit. Then also you can have wrong entries and what have you. Those are some of the things I think could be responsible.
Okay. Now, this question mark which means the difference can be attributed to 1. What comes to my mind anytime I have issues in accounting is to look for errors or errors. And this error might be probably somebody has paid somebody, you applied it wrongly to another person and all sorts of things. Upon reconciliation, you can trace it back. Am I making sense, sir?
Yes, sir.
An error?
Yes,
Yeah. Now, if it's error, what do you do for error? If it's error, what do you do to error? You correct for error. Is that not?
Once you find out, yes.
Yeah. Which means if it's error, when you correct for it, this supposed to be the same.
Yes.
But evidence shows that one, it may not be error, or if there's error, you've corrected for the error, but it still failed to agree. What else can account for that? What else can account for that is what Enaro said, that there might be cash in transit, and there might be what? Goods in transit. Who can explain the modus operandi of cash in transit? What do we mean by cash in transit?
Also, let me just, I don't know, we'll call somebody.
Okay, let me give a little idea that I have. Okay, cash in transit means that if there has been transactions between the parent and the subsidiary, let's assume that the subsidiary purchased or sold, okay, let's say subsidiary purchased goods from the parent, and after the transaction has been recorded, then the subsidiary has made payments to the parents. In the books of the subsidiary would have left his own cash book that he has made payments. And if the parent has not received it, the parent will still be carrying the subsidiary as a debtor, so which can explain the cash in transit. And the same also goes for goods in transit. If the subsidiary has recorded in his own books that he has sent some goods to the parent, and in his books it has left his inventory, while the parent has not yet received it and has not recorded it in his own books. That's goods in transit.
That's perfect. Now, let me give you a real life example of cash in transit today. When we say cash in transit, we are not necessarily talking about physical cash, because nobody moves physical cash in that light again. Okay, we are talking about situation whereby, have you found yourself in a situation where you've done transfer from your bank account, you have been debited, but the person said he has not received money, or probably the person goes to the bank to complain. Something might just fail, whether through the interswitch or through RTGS or NIMS or one story or the other. Now, this cash in transit is prevalent if at the end of the year, let's say on 30th of December, let's say it's on Friday, a bank will open only on Friday, not on Saturday. You've done a transaction and you have sent instruction to the bank, and the bank has debited your account with the hope that they've credited your subsidiary's account in another bank. Now, unfortunately, the year ends 31st of December, which was on Saturday. Nothing can be done until Monday, which is 2nd of January. Now, but your account balance has been depleted and you have more or less paid in all respects. And your subsidiary has not received. Therefore, no matter what you say, the subsidiary cannot claim he has received money that physically he has not received. Therefore, it means as at the end of the year, you will have reduced your payable to your subsidiary, while your subsidiary would not have done so with respect to receivable from you. Why? Because it has not come in. And peradventure, the money came in on 2nd of January. It can never be backdated to December, because cash is what was present in your hands, whether by way of bank balance or by way of physical cash, not by way of, yes, I got it, but I can walk it back. No, cash is cash at that point in time. Therefore, on that basis, it will look as if your balances are not in agreement, but they are only not in agreement at that moment, not subsequently. But at that moment, what then do we do for the purpose of consolidation is for us to identify that amount of cash in transit and pass an adjustment at the group board level as if that cash had been received as at the date of reporting, which means as at the consolidation date. And how do we do that with respect to cash in transit? With respect to cash in transit, the first step is to reconcile the balances. How do you reconcile the balances? I go into payables account. I go into receivables account. Who has a payable? Susie. Who has a receivable? Pali. Now let's look at the account as per what is in the individual books. As per individual accounts. The person that is to receive says 10. The person that is to give says what? 8. Therefore, there's a difference of 2. Now, in this question, they've done the analysis, they found that it's not error and it's not goods in transit, but they found out that it is what? Cash in what? Transit. Therefore, what do we do if that is the case? These 2 has been attributed to cash in transit. Therefore, if the payment has been made and the cash is deemed to have been paid, therefore, we are going to more or less consider that the adjustment to cash in transit is that 2 has finally been received by the parent. And if that is the case, it means this is 8 and this is what? 8. This is our agreed intercompany balance. How do we pass this entry of 2? Is that we come here to recognize as at the reporting date that this cash is part of our group cash position, even though it's a cash in what? Transit. And we recognize that the parent has received this amount of cash with how much? With 2 million naira. The entry that affects receivable is what makes this to reduce, because a credit to receivable is a reduction. This same entry, you can also pass it in another manner. I will explain. This same entry I can also pass it in another manner to say, if I don't want it to affect I'm trying to reduce this. Go on. Let me leave it the way it is. Alternatively, I can equally pass the adjustments against payable rather than receivable. How do I do that? These two, I can assume that the money is to be reversed back to the person that paid. If that is the case, that means let's say it's a failed transaction. Therefore, you add it back because the money came back to you, which means your payable will increase to 10 and everything comes to 10. How do we arrive at that? It's because instead of crediting your receivable account, what rather did was to credit the payable account, given that the money returned to the payer. And which means you are crediting. When you credit a payable account, you are increasing the amount of the balance, which means regardless of whether it is 8 or it is 10, one thing that is paramount between the two is that these two will cancel one another. And it won't, whether it is 8 or 10, will not reflect in your balance sheet. That is why the adjustment, whether it affects receivable or payable, does not make any difference. And that's what I tell my students, so that you don't just cram and say, okay, when does it affect payable? When does it affect payable? No, because all of it is to agree the balance and eliminate it. Therefore, whether you agree it at 8 or you agree it at 10, one thing that is paramount is that one, you recognize your cash, which means the two entries depict that cash position should be recognized. And two positions agree that the agreed balances have to be eliminated. Therefore, that is how that is done. Therefore, to continue, what is our goodwill? Pali's investment in Suzy and the amount of NCI's investment in Suzy. We compare that with the fair value of Suzy's net assets as at the date of acquisition. The share capital and our pre-acquisition reserves. What is your share capital? $100. What is our pre-acquisition reserve? It's not different from what we had before because it's the same question. Remember, we had 60 before because everything was still as at the date of incorporation. And 60 is our post-acquisition, pre-acquisition is 0. Remember, incorporation. And what's this? 100? What do you have? 100. What is investment in Suzy? Pali invested 100, and amount of NCI will determine it. What's our NCI? 20% of this 100. That's 20. Therefore, our good is 20. Our consolidated reserve and NCI as at 31st December 2015. Pali's reserve $140, NCI 20. NCI as at acquisition dates $20. Share of post acquisition profits ratio 80-20 of 60 is 48 and 12. All things being what? Equal. Okay, I think we didn't show the group structure earlier on. I don't need to waste time. Let me just copy the group structure here. That's a similar question. Okay. Now let's copy the balance sheet. Okay. Let me clean it up. Okay. PPE. $110 and $120. That's $230. Goodwill is 20. That gives $250. Inventory, 30, 45. That's 75. Trade receivable, 15, 12. 27. Current accounts, 10, nil. 10 and nil. But don't forget, there's an adjustment that we created here. Either of the adjustment, probably let's adopt this. Adopting this means we adjusted against our receivable 2 by crediting it with 2, cash in transit. Therefore, I'll come here minus 2. And finally, we are to eliminate the 8. Eliminating the 8, remember the entry we passed, or we are to pass, is similar to this entry, which is, instead of 10, it will now be what? 8. Therefore, debit current account payable by 8 and credit current account receivable by 8. And therefore, doing that, I'll come here and deduct 8. Doing so, give me nil, similar to what we've done before. What is my bank? My bank balance are 5 and 7. But don't forget, in this entry here, there's a cash in transit that was not reflecting in either of the books of the parent or the subsidiary, which is part of the cash of the group, which we are told to recognize. An increase in the group cash position by how much? By 2. Therefore, I come here to recognize amount of 2 million that is neither in the parent book or subsidiary book, but is the money that belongs to the group. And these 2 and these 2 has a relationship. And this is what? 14. 75 plus 27 plus 14 will give me 116. 116 plus 250 will give me 366. That is our total assets. What is share capital of Pali? 80. What is consolidated reserve? 188. What is NCI? 32. And all in all, 300. What's our payable? 50 and 16. What is current account? Is 0, nil, and 8. Is 0 and 8. But don't forget the adjustment we make mention of, where we said this 8, we have to eliminate it against the payable account. A debit to a payable account is a reduction in a liability account. And therefore, I reduce this by what? By 8. When you look at everything, you cancel out. You even what? 66. What do you have? 366. And that is a position. Eight, 0, 66. That is a position. Any question? This same process is what you are going to do if it's goods in transit, and I'm going to show you. But any question at this point? Any question at this point? Okay, if there's no question, let me copy out if it is goods in transit, and let's see how the adjustment will show the same position. Now look up now. I've changed it to as opposed to cash in transit, the same question. As opposed to cash in transit, it is what? Goods in what? Transit. Now I'll copy out the solution and I'll show you where the difference lies. Okay, I'll copy the solution. To eliminate intercompany balance. Now, you know, in the last example, I used 8. In this one, I'll try and use 10. Okay, so that I can see that regardless of whether 10 or 8 is the same. But the only thing I will emphasize here are as follows, that instead of cash in transit as an adjustment, I'll change it to inventory, which means the adjustments only affect what? Inventory. Which means the adjustment I'm making is against goods in transit. Therefore, it affects our group inventory. goods in transit. It affects our group what? Inventory. Now, all other things remain the same, which then implies that when I come to the balance sheet, since it's not bank that is affected, this adjustment is not required. Therefore, I will adjust it against there's no adjustment here. This is purely 12. That too, instead of adjusting it against bank, I'll adjust it against inventory too. What does that signify? It signifies that this is no longer 75, but rather this is 77. Because it's not inventory that causes the difference. Sorry, it's not bank that causes the difference, it's inventory. Now, secondly, the adjustment of 2 is against, which is what I'm doing here. I'm using this second one, this alternative. That's what I'm adopting now. That's what I'm adopting in this case. Here, I'm not adopting this one. Now, if I'm adopting this, what you simply tell me to do is that first, as I increase my inventory, I should increase my payable account, which means receivable account is not affected by that. Therefore, I take this adjustment out. Rather, I bring the adjustment here. A credit to a payable account is an increase in payable. That's it. Now, what is the agreed intercompany balance that to be eliminated? It is 10. Unlike this case when it was 8. It is 10, 10, 10, which means when I come back here, the entry I pass with respect to elimination that's it. Okay, it's still up. Is this 10? Now, it is 10 that we are passing an adjustment for, which is this. Okay, if that is the case, it means what I'm eliminating is not 8, but what? But 10. Therefore, I'm going to remove the 8, which means 10 plus 0 minus 10 will still give me 0. And here, minus 10, because the intercompany balance we said we should eliminate is minus 10, which means 0 plus 8 plus 2 will give me 10, minus 10 will still give me what? 0. Which means if it's cash in transit, adjustment affects inventory. Sorry, if it's goods in transit, the adjustment affects inventory. If it's cash in transit, it affects bank or cash and cash equivalents. And likewise, if you eliminate, if you make the adjustment against receivable, receivable will be reduced. If you make adjustment against payable, payable will be increased, but the balances will still agree. and will still be eliminated. And the balance sheet position will still remain the same, regardless of what the position is. Any question on that? If I decide to copy the former balance sheet and put it at the side, you'll see where the difference lie. This is the former balance sheet when it was cash in transit, and when we adjust the cash in transit against receivable, and we are putting it side by side. We are putting it side by side with, now, let me show you where the differences lie. Inventory was adjusted here for these two, but here, bank was adjusted for the two. Now, even though it was 10 that were eliminated here, and it was 8 here, the results still remain the same. The same thing here and here. That's why I said, never focus on who should I adjust against. Is it receivable or payable? Regardless of the way you go to, you get the same position. But what matters is to identify whether the adjustment so called for is against inventory, be goods in transit, or against bank, be it what? Cash in what? Transit. Goods in transit or cash in transit. Any question? Okay, I want contribution from you guys now. I don't call names. Who will start? Madam Oladokun. Any contribution?
I don't have a contribution per se. I kind of have a question.
Okay, what's it? What's the question?
So, in a situation where the parent, Yolusa, can you hear me?
Okay. Yeah.
Okay, I say in a situation whereby we only have trial balances of the parent and the subsidiary, is a consolidation possible?
Yes, when you have trial balance, it's a balance to prepare the financial statement.
So I can't hear you.
It is from the trial balance you prepare the financial statements. Therefore, you can consolidate with a trial balance. You can even, in practice, you consolidate at trial balance level.
Okay. So, what if there are no adjustment, no nothing? If it's just the trial balance, is it just do we just consolidate like that, or there have to be notes based on these scenarios that we are having? We can see that there are instances whereby maybe intra-group inventory, then the depreciation in assets. What if there are no such interest, just the TB? Is it still possible?
It is possible, because the question is this: who owns the TB? You are the accountant. Therefore, you know how you come across the TB. You know what are the GL lines. You know what is intercompany balances. You know transaction you have done. Therefore, you have the responsibility of collecting those things that will lead to the adjustment that you need to make. Nobody will tell you. For example, all this information somebody is telling us is the group accountant that knows about it. For every intercompany transaction, there are documentations. And even on the system, it shows that, okay, I bought something from my parents, I paid my parents this, the balance, everything's are there for you to extract and to consolidate with, subject to relevant adjustment. Nobody will feed you all of this information that is being provided to us in real life. You feed yourself because you are the one that is consummating those transactions. You keep the records. That's why in a group structure, you have what we call intercompany management desk or department, which sit at the group level, where every transaction that will cut across the group will pass through that function for documentation. Nobody will come from anywhere to come and tell you what the intercompany balance is.
Thank you very much, sir. Your explanations are okay.
Okay, thank you.
Clear, sir. I'm clear.
Okay, who else? Okay, I'll give you 10 minutes to use the same knowledge you have to carry out this elimination. I want somebody to do it, just whether you use Excel or you use any other thing you want to use. This with respect to loan. You have 10 minutes. You have to consolidate as at 31st December 2015. You have 10 minutes, just do your rough work immediately. Everything, can you read the question?
Illustration 13. ACTI acquired 70% of the ordinary shares of Manchester United on 31st December 2013, when the balance in the later retained earnings stood at 40 million at a consideration of 220 million, and also invested the sum of 100 million in the 10% loan notes of the subsidiary. Statement of financial position as at 31st December 2015. Arsenal, Manchester United. All figures in million. Property, plant and equipment, 560 million for Arsenal, 260 million for Man U. Investments in Manchester United, 320 million. Current assets, 260 million for Arsenal, 280 million for Man U. Total 1,140 million for Arsenal, 540 million for Manchester United. Share capital and reserves. Equity share capital 600 from Arsenal, 250 million for Man U. 8% preferred share capital 100 million for ASNA. Reserves, retained earnings, 290 for ASNA, 50 million for ManU. Total, 990 million for ASNA, 300 million for ManU. Non-current liabilities, debentures, 120 million for ManU. Current liabilities, 150 million for ASNA, 220 million for ManU. Total, 1,140 million for ASNA, 540 million for ManU. Thank you.
Okay. Thank you very much. Now, this is structure, which is what you just read. And the reserve of ManU is 50. Okay, plus 50 as at the reporting date. And when it was acquired, the reserve was 40. Therefore, the balancing figure there shows increase in reserve from 40 to 50 by how much? 10. Now, let's look at investments. Analysis of ASNA's investments in ManU. It has 3 investments in ManU, namely ordinary shares investments, preference shares investments, and what is the third one? Invested in the bond, Abi? Loan notes. Loan notes. Now let's start from loan notes. You invested 100 million in loan notes. And we are told that he acquired ordinary shares in Manchester United at a consideration of 220. Okay, but what is shown here is 320. Okay, and this 320 is analyzed as follows. 220 in ordinary shares, nothing in preference share, and 100 in loan notes. That's how we arrive at 320. Now, even though, again, the subsidiary has no preference share capital, nil. Therefore, there's no investment in that. That is our 320. Okay. Now, what do we do to loan notes? Loan notes constitute across the group, constitute an intercompany balance, which requires elimination upon consolidation. How do you do that? Now, if we come back to this question, the entire loan note by way of debenture of the subsidiary is 120. But there's a claim that the parent only has 100, which means of this 120, 100 is owed to the parent, 20 is owed to third parties. In that case, what constitutes intercompany is the one to pay, which means in that case, that liability account, we eliminate it to the extent of 100 million, which is debenture. Is a liability account. And we eliminate the loan investment by Arsenal, all in the sum of how much? 100 million. That's how we eliminate. So that of this 320, 100 has gone out of it, remaining 220, which is this. Now, goodwill. If any. Cost of business combination. Arsenal's investment in Manchester United. The equity investment is 220. NCI. Fair value of the identifiable net assets as at date of acquisition. Share capital and pre-acquisition reserves. What is the share capital? 250. What's the pre-acquisition reserve? 40. 250 and 40. That gives us 290. %30 of 290 million. $116. $116 plus 320. $436. Okay. Yes, 146. Sorry, 290 times 30%. Sorry, 87. This 87. It is 7. And nobody corrected me. That's 307. That gives 17. Goodwill. Consolidated result. And NCI as at the reporting date. Arsenal's reserve. $290. NCI as at acquisition date, 87. And share of post-acquisition profits. That's ratio 70 to 30. 70 to 30 of how much? Of 10. To 30 of 10. That is 7 and 3. 297 and 90. Therefore, I can copy the balance sheet and clean it up. Okay. ASNA as a group. What is the PPE?
590 to 60.
560 to 60. And that should give me 80/20. Is that correct?
Yes.
Investment cancel out 220 and 100 has gone out, leaving out goodwill of 17. Current assets. Okay, the current assets sum up 260 and 280. Current assets is aggregated 260 and 280. That's 540. Let me clean that up. Okay. When you add that up, 837 plus 540. That gives 1377. Share capital, Arsenal, 600. Share, preference share, 100. %8 preference share,
100.
This is 600, 100. Consolidated reserve, 297. Equity attributable to Arsenal, 297 plus 600 plus 100, 997. NCI, 90. That's 10,087. Now liabilities.
Ratio 20.
This total equity. Non-current liability.
20. Debenture.
Debenture. The parent does not have loan. The parent does not have 0. The subsidiary has 120. It is 0 plus 120. And remember, we said we should eliminate. We said we should what? Eliminate. How much? 100. Therefore, we deduct 100. Minus 100. That gives 20. And we have current liabilities.
150 plus 20.
150 to 20.
It's 370.
That is what? 37. 370 plus 20 plus 1087. Give me 2194. Is that correct? No, 2194.
No, no.
It's 1 plus 20 plus 370. Give me 1477.
The balance.
One, 4, 7, 7. Now it didn't balance, okay? Who can tell me why it didn't balance? Who can tell me why it didn't balance? Look at the question again. Who can tell me why it didn't balance?
But it's maybe the debenture Eliminating was
You can tell me. You guys did yours now.
I said you got balance in my own.
It's still a debentures that was recognized and loan, but not we've not done anything with respect to debentures.
Okay.
We've not
Yeah.
eliminated it in investments and the subsidiaries.
Okay, I think we have. Let me show you this. Can you cast these figures? Can you cast these figures? Do I agree?
I've got 300. Yes. It agrees. No, there is 100 missing. Yeah.
Okay, now this is not 220.
Exactly.
It is 120. This amount is not 220. It's supposed to be 120 to arrive at 540. Therefore, you can change it from your own side. Therefore, this is not 220, it is 120.
Okay.
That means none of you spotted it when you were doing yours.
I did not actually complete my own.
No, I completed it, but I just thought I made a mistake when I saw the difference of 100. That's what I was expecting you to resolve it for us.
Okay, the final adjustment we are going to use to wrap up is dividend. And I'll give you an illustration that will assist us. Any question before we move further? Any other adjustments? Any other adjustments or any other question? Okay. I want somebody to read this question out.
Okay.
Elimination of dividend balances across the group.
Illustration 18. Paramade PLC acquired 80% of the shares of Adebayo PLC as at 31st December 2015, when their retained profit of the latter stood at 40 million. The statement of financial position of the dual entities are as shown below. Statement of financial position as at 31st December 2016. Paramade PLC, Adebayo PLC. All figures in million. Property, plant and equipment, 130 for Faramadi, 120 million for Adebayo PLC. Investments in Adebayo PLC, 100 million. Current assets, inventories, 25 million for Faramadi PLC and 45 million for Adebayo PLC. Account receivables, 12 million for Faramadi PLC and 12 million for Adebayo PLC. Dividend receivable, Faramadi PLC, 8 million. Bank, Faramadi PLC, 5 million. Adebayo PLC, 7 million. Total, 280 million for Faramadi PLC and 184 million for Adebayo PLC. Equity and liabilities. Equity ordinary shares of 50 kobo per share, 80 million for Faramadi PLC and 100 million for Adebayo PLC. Retained earnings, 140 million for Faramadi PLC and 60 million for Adebayo PLC. Current liabilities, accounts payables, 40 million for Faramadi PLC and 14 million for Adebayo PLC. Dividend payable, 20 million for Faramadi PLC and 10 million for Adebayo PLC. Total equity and liabilities, 280 for Faramadi PLC and 184 for Adebayo PLC.
Okay, thank you very much. Now, what is the emphasis here? The emphasis here is nothing other than you find out that you have dividend receivable and you need to ask more questions. This dividend receivable of 8, I have dividend payable here of 10. Let me highlight it. The highlight is too big. Okay. What does this mean? This means that Faramadi PLC has some equity investment where dividend has been appropriately declared and he has recognized an income, but yet to receive that dividend in cash. Therefore, this constitutes a receivable in amount of dividend, which is an asset to the parent. But we need to analyze the dividend to know where it is coming from so that we can know those from subsidiary and those from others. Others are those other investments that do not qualify as subsidiary. Others can include investment that qualify as associates, investment that qualify as joint venture, or any other trade investment or financial asset investment, simple investment for that sake. Secondly, we look at dividend payable. There are two here. Dividend payable by Faramade, everybody knows that it is to the shareholders of the parent. Is that not? But dividends declared by Adebayo is to the shareholders of the subsidiary. And who are the shareholder subsidiary? One, the parent, and two, the NCI. And when the subsidiary has dividend payable, it means he has declared dividend and he has used that to reduce his retained earnings and is here to pay. That's why it's recognizing a liability. Now, this liability is to all shareholders. And remember, shares are to be shared in proportion to which the share profit or loss. What is the proportion of the share profit or loss? We'll see that from the group structure. Faramade had 80%. Hence, NCI will have what? 20%. When was the date of acquisition? As at 31st December 2016, and we are reporting when? 31st December 2016, which means a year apart. Now, which means this dividend will be shared in the ratio 80-20. How? We carry out what we call dividend analysis. Let's analyze this dividend. Adebayo payable in amount of dividend is how much? Is 10 million. This 10 million is payable to share what? Holders, which we have grouped into two. The parent is a shareholder. Others are shareholder. Faramade and what? NCI. What ratio? They are to share ratio 80-20. Invariably, 80% of 10 million, the entitlement here is 8 million. 20% of 10 million, the entitlement here is what? 2 million. Hence, the amount that is intercompany is what is between the parent and Adebayo out of this 10 million, which is what? 8 million naira. Therefore, the 8 million is the intercompany dividend payable. Therefore, what do? Let's go back to our balance sheet. What we have here is 8, which means this 8 million here, at this point here, explains the 8 million that was already recognized in the balance sheet. But I put it to you that what if in the balance sheet, what you have is not 8, but you have 9. That 9 means that 8 is to the subsidiary, receivable from subsidiary, and 1 is from other what? Investments. Which means the portion that is only required to be eliminated is that of the subsidiary. Which means if we do that, it means after eliminating 8, it will remain 1 out of 9. But in this case, it's only 8 that we have. Therefore, when you eliminate 8, what is left is what? Is 0. Now, in that case, what do we do? We pass the entry and say, debit, dividend payable by subsidiary, and credit, dividend receivable from the subsidiary. How much? 8 million. Doing so will make us to have, if we take away this 8, which is the parent, and we cancel it against this 10, what is left is 2. And this 2 is what we are going to consolidate with this 20 to show the total dividend payable outside the group, which is 22. Whereas here, we'll have canceled out this 8, which means we cancel out 8 against 10, remaining 2. Now, let's move further. Adebola's reserve as at the reporting date, let us decompose it into pre and post. Pre-acquisition reserve is as at the acquisition date, 2015, and post-acquisition profit or loss is the balancing what? Figure. What is that? As at acquisition, the reserve stood at 40, but today the reserve is what? 60. 60, 40. What is the balancing figure? Mute. Okay. This is 20. Now, what's our consolidated reserve? Okay, let's determine our goodwill first. What's our goodwill? All figures in million. Cost of combination. Faramade's investment in Adebola. How much was it? 100. NCI is 20%. What is the fair value of Adebola's net assets? Share capital and pre-acquisition reserves. What is the share capital? It's 100. What is pre-acquisition reserve? It's 40. 100 and 40 will give us 140. 20% of 140 million. %20 of 140 million is 28 million. That's 128. There's a difference of 12, which we'll have considered as a negative or goodwill. Who can recall the treatment we should give to this? What treatment should we give? What treatment should we give to this? And now,
okay, I'm with you.
what treatment should we give to this? When you have a negative goodwill arising from acquisition, how do you treat it in line with IFRS 3?
Okay, for the purpose, we have to look at the re-examine the fair value of
Yeah, we have done that. Let's assume we have done all the re-examination or reassessment, and you still find out that you have this position. How do you treat it?
I think I think I've forgotten.
Can you assist him?
Sorry.
I can't hear you.
I believe the treatment we give to gain on bargain purchase is to move it to.
Okay, first you treat it as gain on bargain what? Purchase. And how do you now recognize gain on bargain purchase?
We treat it as a reserve for the parents.
Okay, now you show us where we are going to treat it as a reserve for the parents. Okay, what is Farmers reserve? Farmers reserve is 140. NCI as at acquisition date is 28. Share of post-acquisition profits is ratio 80-20. And what are we sharing? We are sharing 20 million. 80-40 of 20 million is 16.4. Okay, now, Nuruddin, can you tell us how we treat the gain on bargain purchase, as you have explained it earlier? How? You are muted.
My children are disturbing, sorry.
Okay, how do you treat it first?
I'll just put it under consolidated reserve.
That means you treat it as a gain attributable solely to the parents.
Yes.
Without any contribution to the NCI.
Exactly.
Okay. That is a professional way of expressing it. Thank you. Therefore, I can go ahead to copy my balance sheets. Okay, this balance sheet looks totally different. Let me just do it afresh. Okay. Firemartin Group, consolidated statements of financial position as at 31st December 2016. All figures in million. Assets, non-current we have property, plant, and equipment. We have 130 and 120. If you remember, 130 and 120. You have inventory, 25 and 45. You have account receivable, 12 and 12. Is 250. Investment cancel out. It didn't result in the recognition of goodwill. Rather, it resulted in recognition of gain of bargain what? Purchase. Current assets, we have inventories, which we said is 25 and 45, 60. We have receivables, which are trade receivables. We have 12 and 12, which is 24. You can see them here again. Now we have dividend receivable, 8 and nothing for Adebayo. Dividend receivable, we have 8 and nothing for Adebayo. But recall, we said we should eliminate this dividend receivable by the sum of what? 8 million, because it's intercompany balance. Therefore, I come here, I'll say minus 8. That gives what? 0. Thereafter, I have my bank, which is 5 and 7, 12. Let me show you where bank is. 5 and 7. Now, can somebody put up a calculator to sum up this, so that we can determine our total assets?
96.
Let me check. 60, 24 plus 12, 96. 96 plus 250 is 346. Okay. Equity and liability. Equity comprises of share capital and reserves. Share capital, Faramade, retained earnings as consolidated. Okay, what's the share capital again? 80, and consolidated retained earnings 168. and 168. That gives 248 as equity attributable to the shareholders of Farmadi. Equity attributable to non-controlling interest. That is 32. That should give us 280, our total equity. Current liabilities. We have account payable, 40 and 14, which is 54. Again, you can check it here, 40 and 14. We have dividend payable, which is for the parent. I'll show that separately. Dividend payable. I'll break it into two. One payable to Farmadi's shareholders. That is 20. And the one after elimination that is due to non-controlling interest, which is 2. How do you arrive at the 2? Can you remember here? This 10, we analyze it into 8 and 2. This is where we analyzed it, 8 and 2. And this 8 was canceled out, which is the process you found there, okay, which we are going to come and show you in the balance sheet, which left out this 2. Okay. Now what do? This 2 is the same thing as saying from this 10, you know, we eliminated 8 the other time. That 8 is what I also deduct from here. That is eliminating intercompany balance, 8. And that gives this 2. Everything giving what? 22. 22 plus 54 will give me 76. All things being equal, that gives me total equity and liabilities. One is showing 346, one is showing 356. Is there something wrong? Or we had one wrong? Which way? Can you confirm? Can you confirm? Can you confirm? Is there a casting error in this case? Okay, can you look up here? Look up here. We sum up. You have to be careful with your calculator. I think we didn't use calculator here. We sum up 25 and 45. And we claim it is 60. Is that correct? I can't hear you, Nilden. Is that correct?
Yes, yes. Yes.
25 and 45 is 60.
That's correct. It's 70.
Is 70. Therefore, take note. If it's 70, if this is 70, therefore this will be what? 106. plus this is what? 356. Therefore, that's another lesson that sometimes when you use your memory to calculate, you might be calculating wrongly. The best thing for you is to ensure you use your calculator at all points in time. This is how we eliminate dividend after carrying out dividend analysis. Any other question? Okay, remember our discussion with respect to dividend analysis, and where not all times do you eliminate all of these dividend receivable of 8, because anyone attributable to others will not be eliminated. Rather, it will be shown because it's a payable or receivable from third parties or from outside the group. Any other question? Okay. In the absence of any other question, we can call it a day. Thank you very much, and God bless you. I'll share these results on your WhatsApp platform.